Hi everyone, so let's take a look at supply side policies, really important area of macroeconomic policy undertaken by governments. Okay, so these represent attempts by the government to improve aggregate supply through individual markets. Now they can either take place via market-based approaches, so we see for instance the capital markets, the labour markets and the goods markets. These are prime examples where supply side policies would be introduced, or alternatively they may be as a direct result of government intervention that they are undertaken here. Okay, so let's have a little run through some of the examples I've put down here. So firstly, we've got corporation tax cuts. So corporation tax cuts obviously enable firms to actually retain more of their profits, and that gives them more opportunity to undertake investment if they so wish. And that can help to boost productivity in the longer term. Secondly, we've also got this point about improved access to capital markets and ensuring that medium as well as large size firms have the full access to capital markets, which will provide money to companies that should grow and be reflected by higher share prices therefore, and obviously those capital markets are very efficient in allocating money away from companies that should probably retrench or become a little bit smaller, and their share prices would correspondingly fall. But there's also of course the corporate bond market is another example there. So access to capital, very important. Okay, so let's have a look at labour markets. Well, here it could be about offering lower minimum wages. Lower minimum wages may encourage that may encourage of course more staff to be actually employed, and that can help to boost the level of employment within an economy. Okay, so we've got that first point there, but it's also interesting to note that actually having higher minimum wages or higher living wages we also have can also encourage firms to actually substitute labour for capital. So this can be taken in two directions really, this point. Okay, then income tax cuts. Well, we've had a look at the Laffer curve and how cutting income tax can actually encourage labour to be incentivized to work because the incentives are improved and work is better rewarded when you are taxed less on that work. It could also be about reducing the power of trade unions there as well, so ensuring that they cannot actually strike or engage in strike activities unless a sufficient number or percentage of their trade union membership is actually voting for such action. That's certainly a good example of recent times. Then we've got promotion of training and apprenticeships, and of course this is something that the government has tried to use deliberately to help to reduce unemployment among youth workers. Okay, so people who are just looking for their first job. So the option of providing apprenticeships has previously been subsidised. Okay, then it could also be about improving labour market mobility, so that people are more prepared to move geographical location, as well as improving occupational mobility, the ability of people to actually move from one particular area of work to another. Okay, and it could also be about reducing benefits. Okay, so reducing job seekers allowance and any other benefits that you think might be actually encouraging people to not work. Okay, that's a controversial one obviously, okay, but there is the potential for the unemployment trap there. Okay, so let's have a look at the goods market. So when it comes to the goods market, well, classic policies that have been introduced under Reagan and Thatcher have involved privatisation. Privatisation, of course, is really about turning nationalised companies into private companies that are listed on the stock market. The most recent example of which is, of course, Royal Mail. So privatising firms is argued by free market economists and supply side economists to improve the efficiency and the operations of those given firms, because they now work for profit. They should be privatized into a competitive marketplace as well, so that they are not simply becoming a private monopoly, okay, and that is a danger of such policies, of course. Then we've got the notion of deregulation, of course. Deregulation in the skies and has really enabled a lot of improvement in in the competitiveness of the airline market, as well as, of course, privatisation policies. And the airline market has been a huge success of such supply side policies. And then we've got this point about trade liberalisation, so ensuring that trade is liberalised and you can actually undertake trade in goods and services very easily. Okay, so being able to do so enables you to gain supplies and component parts for your products from abroad very easily, and of course that's important there, okay. And it enables that international trade to be facilitated as well. And then finally, this point about promoting entrepreneurship. That was another policy which was used after the financial crisis, so it's another significant one. Okay, so let's now take a look at these interventionists approaches that we've got here. So, well, we've got the fact that this is likely to involve direct government expenditure on perhaps the infrastructure within an economy. So we have a big infrastructure project underway at the moment with the HS2 high-speed rail link, which is meant to create this Northern Powerhouse, or is part of the Northern Powerhouse project, but it's highly controversial because of the huge cost and the length of time this is actually going to take to actually come into fruition there. Then it could also be about education and training, and the government actually dictating particular areas that they expect school children to actually be educated and trained in, perhaps. And then there's subsidies for investments and research and developments. Those subsidies could come in the form of tax breaks, of course, on investment, research and development, and that is investment into capital goods, of course. Okay, so what's the desired impact of these different policies? Well, it's about increasing the trend rate of growth. It's about increasing economic growth, reducing the price level, and increasing innovation, productivity, and improving international competitiveness, which would help to actually boost the economy's current account position as well. Okay, so interesting points when it comes to potentially resolving that net exports issue. Okay, so let's now just have a look at the diagrams for this. So I've just drawn out a classical and a Keynesian diagram here, and we can just illustrate the intended impact of these supply side policies on both diagrams here. So we get a shift of the long run aggregate supply as a consequence here. It's worth noting that many of the effects that we see here, of course, will have a microeconomic impact on the marketplace in these areas. But the intention, of course, is to shift the long run aggregate supply curve, and we can see that here, and we can see that economic growth increases while the price level falls. Okay, so we see that under our classical model of the vertical inelastic long run aggregate supply curve. Meanwhile, under the Keynesian model, we can see this sort of scenario playing through, that we achieve long run aggregate supply curve 2 there, and that is of course at a lower price level and a higher level of economic growth. Okay, so the impact is much the same, really. Okay, we see those intentions of increased economic growth and reduced price level quite clearly in those diagrams. Really, the question is, to what extent will they really help to generate such improvements? Okay, so this leads us on nicely to our evaluative points here. So first point that I've put down here is how much is this going to cost? Supply side policies can be hugely expensive. And don't forget, we've got a big fiscal deficit, a big fiscal hole, which needs filling, and we have an increasing level of national debt. 1.7 trillion, of course, so very, very large. So yeah, what sort of impact is this likely to have? What sort of timescale are we talking with these policies? Okay, so what sort of impact is that also likely to have? Is there a chance of government failure here? So could the government actually make things worse in particular markets? Okay, so some certainly argue when it comes to privatisation that they've made the rail industry worse. Okay, but yeah, it's a very contentious, very controversial issue. What about the opportunity cost? So if this money is being allocated towards education, towards spending on infrastructure, what was the next best alternative that has been foregone? And how did they actually determine why this project should actually get that money? Okay, distributional issues as well. Well, we've seen this point about lower benefits being provided to perhaps some of the poorest in society. So are we going to worsen inequality here? Well, if privatisation leads to public monopolies becoming private monopolies, which are then monopsony employers, then that may further aggravate inequality. Okay, so that may be another issue, as well as, of course, increasing unemployment. Okay, so what is the desired level of unemployment? Okay, so we've also got to actually bear in mind here, when it comes to reducing unemployment, increasing economic growth, that there may be other conflicts with other macroeconomic objectives. And if we do increase unemployment considerably, perhaps because of income tax cuts, well, what's going to happen to the fiscal deficit? Well, the Laffer curve, that we can refer back to that, suggests, of course, that at certain levels a tax cut may actually boost tax revenue, but will that really happen? And what contribution will that actually have to demand pull inflation? So this really leads us towards potential conflicts with other macroeconomic objectives there as well. And will the market actually fix the issue in the longer term as well? So yeah, it's a grey area, as you can see this, for any essays. Okay, so it often does come up, and sometimes it will come up with other macroeconomic policy themes and asks you to consider which policy may be best in given scenarios. Okay, so it's a biggie. All right, thanks guys.